think what we need to understand is that the president has closed deal after deal after deal that are really great deals for the American people. We've got trillions of dollars of new investment coming in and trillions of dollars of tariff revenue coming in that they're happy to accept. The partners, more than 50% of GDP, have agreed to a deal where we tariff them and they open their markets for us. India has been a little recalcitrant, but also I think the president has decided that India should not be the release valve for Russia, and that one reason why the Russia-Ukraine war might be going on for so long is that Russia has a release valve through India where it can sell its stuff. And so the president is serious about getting peace in Ukraine and Russia, and I think that getting a better understanding of India's role is what's moved him to this move.
And that's White House National Economics Council Director Kevin Hassett with me just moments ago, reacting to the trade deals and tariff plans put forth by President Trump, and that is just so far. Joining me now is New York Times bestselling author and founder of the Bear Traps Report, Larry McDonald. Larry, great to see you.
Thank you, Maria.
Well, do you feel like at this point, increasingly, people are understanding President Trump's agenda? I mean, there is clarity at this point, right?
Yeah, he's much more clear now. Bessent and the team at Treasury have done a phenomenal job. Joe Lavorgna and that whole team, I think they're great. I think that Trump still has a 3-month window to play some hardball, especially with this whole funding of the Ukraine war coming out of India. And so think about the midterms are really a year from November, so he can afford to throw a couple more punches.
Well, the market has been on fire, really, money moving into stocks. What are you seeing? I know you've got all these conversations with institutions. Do you feel that they're looking at valuations getting excessive here, or do you think there's new money coming in every day?
Well, we hosted an ideas dinner last week in San Francisco, and a couple of very large institutions that run money for the big guys, the big money families out west, the AI type players. What they've been looking at is the rate of change of tertiary assets, so things like meme stocks, ARK stocks versus Qs. So looking at tertiary plays, companies with, say, more than a $10 billion valuation with no sales. So they have like an index of about 12 of these, so what we call tertiary versus established. So comparing the S&P to these things. And that started to roll over last week. And so what a lot of these momentum players do, when tertiary assets are outperforming across multiple verticals, they increase their exposure to the market. And when that starts to roll over a little bit, they take money away.
What do you make of what's going on in the bond market right now? Yields this morning are higher again. We have the yield on the 10-year up about 2 basis points right now at 4.22%. President Trump is narrowing his shortlist in terms of the chairman of the Federal Reserve. He's named Kevin Hassett and Kevin Warsh as top contenders. Are money managers getting ahead of what no doubt will be a change in the Fed come year end and certainly next year when Powell's term is up?
Yeah, so the weird thing about this rally this week is bonds rallied and stocks rallied. So it's weird. Bond market, oil, there's a lot of things that are pointing toward a slowdown. What we just saw in the jobs market last week. So those things, but you had this counter trend rally in equities. So the institutional investors we speak with are like, okay, hold on. The bond market's kind of telling you that something's coming in terms of a slowdown. Bonds should not be rallying like that if growth's going to reaccelerate.
But do you think that the Fed is gone? Maybe the market is reading that the Fed may cut rates soon?
Well, remember, when the Fed cuts rates, they control the front end. And what we saw in maybe September of last year is when they cut, the long end went up, right? So in other words, when they cut rates the last time, the long end ripped higher, even though the Fed controls the front end. They control that 3-month T-bill.
So you don't think all rates get impacted just because the Fed cuts rates?
Right. And historically, when the Fed's cutting rates, the long end yields are coming down. But what's weird is the last couple of years, we talked about this in our book, How to Listen When Markets Speak, is in recent years since COVID, with all that fiscal and monetary. Remember, the fiscal and monetary response to COVID and the regional bank crisis was $16 trillion. The fiscal and monetary response to Lehman was $4 trillion. So since COVID, when the Fed starts cutting, bond yields have been going up, and that is a big change.
Well, why?
Because of the financing of the debt, right? And because when you tariff the world the way we did kind of aggressively, you kind of scare our trading partners away a little bit. And some of the trading partners are a little bit more they're not as friendly to buy our bonds.
Well, that's what I was saying. I mean, I thought that now people have clarity in terms of what President Trump is trying to do on trade and tariffs. What's your take on the ISM data that we saw this week and what the reaction was around that?
Okay, so the institutional investors are looking at the rate of change of the ISM data, the prices paid. And we just posted I posted on X with you this chart where the rate of change is violent. And so it's survey data, but a lot of the big companies are seeing a big increase in prices that's tariff related. Now, how sustainable that is the question. But the bottom line is we've never cut rates, at least in not my lifetime, with the ISM prices paid moving like this. Typically, when you're cutting rates, the economy's slowing down, prices paid, you've got this deflationary conviction situation. Now we're in a more or less stagflationary world, which requires an entire new portfolio construction for investors watching us.
So
right
tell
now.
us about that. What should the portfolio look like? And I mean, when you hear President Trump, he's the best cheerleader this country has had, and he's talking about a boom in the economy and that the markets will get, reaction from an economy and a macro story that is improving. Do you want to sell into that right now?
The only way out of a $37 trillion debt hole is for people in Washington. They want to massage interest rates below the rate of inflation. It's called financial repression. And in that kind of world, what does really well are commodities, hard assets. If you look at the gold miners this year, they're up 66%.
Wow.
Versus the Mag 7 is just up 5%. Even copper, silver, just companies that control assets in the ground, that's going to protect you against inflation that normalizes at a higher level.
So buy hard assets.
Yeah, hard assets, oil and gas, especially the gas names now. The gas names are really what we talk about in the book is this infrastructure build out, Maria. All the things we hear on TV and watching this show and watching all the shows, AI infrastructure requires a $2 trillion rebuild of the power grid.
Yeah.
So all those growth estimates need more natural gas.
Huge numbers. All right, the book is How to Listen When Markets Speak.
Thank you.
Congrats on the book and its success. Larry, great to see you.
Thank you, Maria.
Thank you so much, Larry McDonald. Stay with us. We'll be right back.